We talked about, people look at candlesticks, red and greens, and yet everybody sees those. So if you're putting too much emphasis on the color of the candles to make your predictions or your trades, you're doing it with information everybody has. Our what we call lasers are these red or green lines that come out of these footprint charts. It's simply indicating where and if there's an imbalance between longs and shorts. If there's more longs and shorts, it's red. I'm sorry, more shorts than longs, it's red. More longs than shorts, it's green. The longer the line, the more shorts than longs there are. Now, the beginning, when it went green to red, we go up. All of these red lasers have since they started, had a little bit of a rally. Not much after this pop, but it's drifted higher. What's important is to first understand the value of other people's positions and when there's an imbalance, but then also when there's a shift. When you start going green for the first time in here, does that mean get short, sell it? Maybe, but it at least starts the beginning of a little bit of a pullback. This isn't a big pullback, but it's a pullback enough, and the biggest one since it rallied. And it started with the imbalance flipping. Now it goes green to red in here. Where does it go? It goes up. It goes back to green. Where does it go? It goes down. This is not oversimplistic. It only seems that way because of all the complexities that are um, doing their work to create the color of the line. The concept of following and tracking other people's positions, then comparing it to something else to find value. Yeah, it'd be fine to know just the longs, but when you could compare it to shorts, all of a sudden you're putting yourself in a position to glean value and therefore probabilities in your predictions. One other thing that I'll mention, and that is when you get um, the market to move, could it be too late? If a fifth grader would say, "Yeah, we're bullish," and it's because the damn chart looks like this, and you ask little Johnny, "Are you bullish?" Of course, but it's probably too late. Not that it can't continue to rally, because it can, but markets are like rubber bands. They're not going to go on forever. They have to snap back, retrace in order to gain the energy to go back up. Well, what's the energy it needs to go back up? It needs more buyers who want to buy it versus sellers that want to sell it. It needs to find them. And therefore, this retracement of any rally comes from a rebalance to shake out what? Longs. Every rally at some point is going to have too many longs. If one, that's why prices will tend to stop going up and have to go down. Too many longs. Because remember, when there's too many longs, there becomes too many sellers. For anybody watching this video or this concept for the first time, if you don't know this, you will now, and that is longs now become sellers, and shorts, after they're short, become what? Buyers to cover the position that they're in. Again, if you don't know that, at least you do now.